Today's topic, or lunch, is titled Time to Invest. And with a lot of doom and gloom, particularly being promulgated by the media, I'm not sure how many media we've got in the room, any show of hands? There's one up the back. It's always good, I think, to put a lot of these things into perspective. And I recall sitting with a senior executive from One Steel back just after the GFC, and we were looking out at one of the ships in the Gulf, and I was talking to him about the cost of that and the fact that the iron ore price had fallen, and I knew that the cost of loading those ships had been around $330,000 a day just prior to the GFC, and I said, you must be wanting to get that thing out of here in a hurry and get that loaded quickly. And he said to me, oh, we're not quite so desperate at the moment. He said that ship's costing us $6,000 a day. So from 330,000 to 6,000, yes, that is the correct figure. Now 6,000, by the way, is not sustainable. I think more like 30,000 is sustainable for a ship. But it's not always about what the commodity price is doing. It's about understanding the total picture and about where you sit in the cost curve when you count everything. And so we thought this was a good opportunity to get some of our experts in today to have a good discussion. We plan on having a little bit of fun today. And I'm going to start off with our first question to Gary Gray, and please, the panel, feel free to jump in if you've got something that you'd desperately like to add, even if I've asked the question of someone else. Gary, Warren Buffett says whether we're talking about socks or stocks, and he means share stocks, not the Andrew stocks. I like buying quality merchandise when it's marked down. When is the best time to buy in resources shares?
Look, I'm going to address first socks. I picked up a pair of Steel Blues bamboo socks the other day. They are fantastic. They wick well, they feel supportive, and are extremely comfortable and don't need to be washed. My 17-year-old son now is the owner of my Steel Blue socks. Look, I think as we look across the resources sector in general, we see some terrific opportunities. Both for large-scale future investment. But importantly, Jason, we've got to have in mind that although the resources cycle has turned, the prices for commodities in general are much more robust than they were 15 years ago, much more robust than they have historically been over the course of the last 25 to 30 years. And the future looks genuinely bright for Australia as a strong resources economy in all sectors. Even aluminium, and aluminium bauxite, which a year ago was looking very depressing, we're seeing some really good movement in those prices. In iron ore, where a lot of people look at iron prices and they compare it to the $160 a tonne that we were getting in 2010, 2011. The reality, Jason, in my view, is Australia continues as a very significant global player. Our companies continue to shed costs through insightful consideration of CapEx, and we continue to shed costs through a tough approach to OpEx. So as we get past that big investment stage and we get into the production stage, we're going to see real benefits for our country, but they won't be flabby, fat guy benefits. It'll be the benefits that we get from being lean, tough producers in a lean, tough, good market.
Fantastic. I'm almost loath to come to you next, Lachlan, because the share market often responds the most negatively to things. But within the resources sector, though, what are people leaning towards investing in right now and over the next few months? And what do you think are the opportunities within the resources sector?
Yeah, it's always tough as a broker to front up with these sort of questions. I guess at the moment, everyone is really drawn to how well a company is run and what their balance sheet allows them to do. And so at the moment, with significant write-downs we're seeing across the industry, and that obviously affects those companies' capabilities of raising debt and the interest they're paying on their debt. And so, generally, it's simple. We just look for those companies that we think are have a really clean balance sheet, are running, as Gary said, running lean operations, and have made the hard decisions, and they're the ones that we focus on. They're obviously the ones that are easier to talk to your clients about.
That would be Senex for anyone who's.
And opportunities going forward. Once again, it's a very crystal ball gazing type thing, which is not an easy thing to do. Being a geologist, I'm quite good at that, but that's in previous life. Look, I think I'm a firm believer in not looking at things on a quarter by quarter basis, and what the metal prices are doing currently. I don't think is a good way to sort of view the resource sector, whether you're talking oil or metals. So I'm a firm believer in the Asian development and that continuing forward, and the demands that will require as far as metals go. So I'm pretty bullish on base metals. I think we're seeing sort of structural shifts in the steel industry and the iron ore industry. So I'm not so sort of certain of where that's heading at this point in time. But I think it's mainly the base metals that I look at. I'm not so on top of the oil and gas and coal sectors. So Ian might have more to add there.
Well, speaking of oil and gas and coal, Ian and I were having a conversation before about the fact that wasn't too many months ago when. How did you describe the coal guys?
You look. It was only yesterday. You look at the coal guys, go, "Oh, you poor buggers," and you go, "Oh, here we are." But we're now oil is in the same boat.
So, and it's amazing how quickly those things can turn, isn't it? But I think, look, Gary quite rightly pointed out before that notwithstanding where prices for many commodities are at today, whether it's oil and gas or iron ore, and we might talk particularly about the two of those given the representatives we've got here today, but they're actually still at historical highs, as Gary's pointed out. Yes, no, it's not at $160 a tonne, but you only have to look back, in fact, I think not just over 25 years, but probably over a 50-year period. And we've had a very good run in the last 8 to 10 years. But if you go back before then, the prices are pretty good today.
About $12.50 a tonne at the turn of the century.
Yeah.
Year 2000.
So, particularly these two commodities that impact you guys. What are you seing, and how are you responding? And do you expect that the companies can still be profitable with with the commodity price as it is today?
Well, I think. Do you want to go first? I think on the oil and gas side, and I'm not a base metals guy. I'm an oil and gas guy. I'm an optimist in the oil market. I think structurally, as Gary was saying, there's an extremely bright future for oil. It's not going anywhere on the demand side, and at the moment we're, notwithstanding some geopolitics that is also playing out, we're in a fundamentally oversupplied global market, and it's a global commodity, and that'll take I think a little bit to work its way through the system, and I think ultimately I'm pretty optimistic in the oil side. I think one of the things that's happening before our eyes on the east coast of Australia in particular are the LNG projects in Gladstone, which is pumped $60 to $70 billion of investment into what was once a stranded resource called coal seam gas or coal bed methane in the US, and it's created an enormous industry and an enormous opportunity for the east coast of Australia, and no one really quite knows how the next 12, 18 months, 2 years, 3 years, 5 and 10 years is quite going to play out. But what you do know is there's a huge increase in demand, and there's not enough supply to meet that demand as it currently stands. And as such, prices rise to try and make that investment signal, and you're seeing that investment go in. Now, unfortunately, with the oil prices going where they are at the moment, that drives a lot of revenue write-downs for the same players who are investing in the gas. So we're in a delay mode as it currently stands. I don't think it changes the fundamentals of the industry at all. I'm very, very optimistic.
Andrew, you're in a little bit different situation in that you're wanting to obviously get your project up and get that investment and convince investors that you've got something worthwhile to invest in. How do you go about doing that?
Firstly, Jason, I think I should start by saying I think we see a theme starting to come out of the conversation here, and that's quality. People get concerned about prices falling, and the nature of cyclical pricing is that they go up and they come down. And for a lot of the commodities at the moment, we see that they've come off. And why has that happened? We had a period of sustained high prices, and you expect supply to come through. And that is exactly what we're seeing. Can good projects still survive when prices are low? Of course they can. Rio Tinto just put out their results, and we all know where they sit. They're very low cost producers, but you know, the overall EBITDA margin was almost 40%. And in the iron ore division, which is what I watch, of course, it was about 64%. So, you know, still very good results. But in periods of low growth, you have to concentrate on efficiency and pushing your costs. And even though we don't have a project that's operational yet, it's very important for us to put forward a project that is efficient. So we do things like in-pit crushing and conveying as an example. Through this process, instead of having 95 trucks driving all the ore and the waste out of the pit, we have the crushers in the pit and conveyors moving the material out of the pit. Reduces the number of trucks from 95 to about 15. Reduces the diesel burn from about 800,000 litres a day to 50,000 litres a day. And it improves efficiency, pushes down the cost. And what that does is embeds low operating costs into the project for the life of the project. And the whole idea here is to be able to weather the inevitable storms that are going to occur. And, you know, I don't think we'll see once in a century pricing any time in the next couple of years, but we see demand tightening up as this next wave comes through, and as a result we should see some strengthening in the prices as well. As the commodity prices go up and we see the new supply coming on, we see a construction boom. We saw that right across the country, but particularly Western Australia, and we saw ridiculous prices being paid for all sorts of things in the push for expansion. What hasn't been communicated that well, I don't think, in the media, is what's happened to the prices since the head's gone out of construction boom. We're seeing sleepers for railway lines have come off about 25% as an example. And as a result of the costs coming off, Iron Road as a company has embarked upon a re-estimate of the capital requirement. Because, you know, for a company like us, the challenge is obviously the equity investment for the project, and we need to put our best foot forward on that.
I suppose that's one of our premises about why this is a good time to invest, because it is a much cheaper time to build, and it's probably and as you say, there's an ability to embed a much lower operating cost into a project rather than you know, when everything is great guns and there's a push to expand almost regardless of the cost. Okay, I'm going to come back to you for a moment. You've been around in the industry for a long time. Some would say that there have been supply wars in iron ore and coal, perhaps even in oil and gas previously. Have we seen activities like this before, and what can we learn from history?
I think when we look at the accusations of supply wars at the moment, what we have to bear in mind is that in the context of iron ore, and specifically it's described in the Pilbara environment with Rio, BHP and FMG, it's in our national interest to continue the drive for the largest amount of exports that we can obtain. And it's in our national interest to have that done at the lowest cost production level. And it's in our national interest to maintain market circumstances that drive that spirit. It's critically important. And so as we look forward over the next 2 years, we'll see, on current estimates, iron ore exports top 700 million tonnes. Might not get to the 820 that we were forecasting 2 years ago, but in the year 2000 we exported less than 100 million tonnes of iron ore in the year 2000. In the year 2000 the average price was in the order of $12.50. We're looking at prices today that are 5 times plus that price. We're looking at volumes that are 7 times plus that volume. Think about my little hometown where Mum still lives, up in Whyalla. Arium looking, notwithstanding their announcements in the last month, Arium looking at maintaining exports in the order of 9 million tonnes in a conjoined transshipping operation of very significant scale. So we're seeing our producers meet the market in an aggressive way. That is what we want. We're seeing our producers attend to their cost structures in an aggressive way. That is what we need. And we're seeing our place in the marketplace being upheld by production being maintained. I see these things as being the critical national interest. Now, I don't think that as a policy maker or a sharer in the policy making process as the opposition, as the shadow minister, I don't see it as being in our interests as a nation to support anything other than a clear, clean market driving our best interest in these locations. Sure, there'll be occasions when we need to support infrastructure. Sure, there'll be occasions when we have to engage in a better way on some regulatory issues. But the simple driving principle should be let the market work this one out.
Okay. You've taken away my next question, which was, is there a role for government at times like that? And I think
get the approvals done as quickly as we possibly can and allow companies to do their business as well as they possibly can.
Very good.
Jason, could I add a comment to that? What you describe in your question as a war, I think what we're really describing is capitalism. And part of the role of capitalism, and it can be brutal at times, is to push out those marginal producers and increase efficiency. And that's part of a natural marketplace. Now, a lot of the people in the room at the moment, because we're in the small space, generally speaking, that can be tough. But that's a system that we grew up in, and that's the system that drives the efficiencies that we see and that Gary's describing. And that's why quality is so important.
Yep. Good. I'm glad to hear you're sticking with capitalism and not taking us down another route. This is a probably question, Ian, maybe Lachlan, you might want to get on this one as well, but media tends to report oil prices out of the US. Is this the best indicator for Australian oil and gas companies?
I think a balanced view of oil prices is you've really got to report WTI, which is in the US, and Brent is the major pricing used outside of mainland US. So in terms of the oil price that we receive on our production, it's on a Brent basis, and there's adjustments up and down for various things, but it's on a Brent basis, and Brent's what we look at.
No, that's what I look at, absolutely, yeah.
Yep. Gary?
Jason, I think it's worth too having in mind, although you look at those prices for now, looking at the forward curve on those Brent prices and West Texas prices, there's nothing but good news for Senex.
Exactly.
Yep.
There's nothing but good news for Australia.
So the prices being in what they call contango, which is the future periods are higher than the current periods. It's quite good if you're looking to hedge out production into the future to guarantee a base price, which we've just done recently as well to lock in our revenue base. I think going on the point around quality, I think was the term used here. It drives lower prices perversely for a very short amount of time. Lower prices perversely really drive focus on execution, and execution being a function of quality. And nothing focuses the mind like crunching cash costs, crunching cash margins, where you know that you need to do things better, cheaper, faster, or pick an adjective that describes the way to execute your business or execute whatever task your guys in the field invariably are doing. Think of ways to do things smarter, put more time into front-end engineering, which when oil prices are $120, I guarantee you that the head office is saying, get that production online, as opposed to, hey guys, step back and think about how we do this properly and then get it online. So that's in onshore oil in particular, offshore very different of course, onshore oil in particular, the attraction with a very, very high oil price is, I think some of the terms used, fat and lazy. Invariably, and you see it across mining, across oil and gas, it doesn't really matter what industry you're in, when you're making huge margins, organisations become fat and lazy. And the price response that comes out of massive supply increases it drives organisations invariably to really focus on the things that count, which is quality and execution. So I think in a very short term, very, very good for the psyche of the company or the individual. Longer term, of course, you want to see prices go up and make more money.
So what you're saying is we're all on a Jenny Craig diet at the moment, is that
it?
As I said, as he breathes in?
You see it though. It's interesting to look at. You see massive capital infusion in when prices are high, and then you see massive layoffs and cutbacks and impairments, and so it is a very, very yo-yo cycle. And you might say, well, that's natural because of the cyclical industry that we are in. Doesn't matter which resource you're talking about, but you take a step back. There's got to be a better way. And I think at times like this, when you've just been beaten over the head by a massive price crunch, I think it makes the industry better for it for a period until, of course, as humanity does, you forget. And then you make the mistakes again and repeat. So the Tom Cruise movie, I think it was, live, die, repeat.
Lachlan, we might touch on that. It's true that companies do exactly as Ian's describing, but I think some of that's often driven by the share market, the expectations with the share market. Would you like to comment on that?
Yeah, I mean, I guess to pick up on one point when we were talking a bit earlier about the pricing in the forward futures curves, I guess to quantify that, looking forward in the medium term, the contracts that are being settled at the moment are about $10 a barrel above where they are at the moment. I think it's about right, give or take. So obviously within the traders are looking on it quite favourably on where things are heading there. I think we saw probably going back 3 or 4 weeks ago when a lot of the oil stocks bombed out that there are a lot of people who had the faith then to buy. Once again, it's the Warren Buffett sort of philosophy where when everyone's greedy, that's the time to get out, and when no one's looking at it, that's the time to get in. And I think that's what we saw 4 weeks ago in that respect.
Good.
And I think what's talked about not often enough also when it comes to these type of commodities is the effect of the exchange rate that has on Australian domicile companies in particular. So in Australian dollar terms, my view is we'll end up seeing 100 Australian dollar Brent in the not too distant future. Now that might be 65 or 70 or 75 US dollar Brent, but with an exchange rate coming down to between 70 and 75 cents. In Aussie dollar terms, which is the vast majority of our costs, you're still back to making very, very good margins.
And we've seen that in the gold sector, particularly in the since the Aussie dollar's gone down. We're back up to plus $1,600 an ounce in Aussie terms, and that's when you're looking at the companies that are producing at around $1,000. That's healthy margins.
Now, either you're enrapturing everybody and means that no one's sent me through a question, or the technology is failing us and it's not coming through to me. Now, Megan, if you do have questions and it's not getting through to my iPad, you better rush up here with some of those questions to give me. If not, I've still got a few more questions to give you anyway. So what I might actually ask you all to do is to actually answer, if you like, the question that was almost premised by us naming this lunch time to invest. Market often gets overexcited when commodity prices are high, as we've just been talking about. In your opinion, when is the best time to invest and why? Who'd like to start?
It's a poison chalice. Look, ultimately...
all the time, I
suppose. Well, I was going to say, it's all the time.
There has never been a better time than now to buy.
I think you've got to think of... sorry, just interrupt you. Investment has two sides. You can be long and you can be short. So you could argue that there's always a time to be investing.
Yeah, the old investment banker.
Not like short.
There's a short window in which to take advantage of this opportunity, and then the window opens a bit wider, and repeat. I think ultimately, if you're smart about it, and it really depends on your investment horizon, of course, you take a view of the underlying commodity, you take a view of management, you take a view of the quality of the resource and the quality of the business, and you make a call. And whether the market's going up or the market's going down, you can make money, because there's always two sides of a trade.
Yeah, absolutely.
Andrew?
Well, I agree with that absolutely. Okay, buy low, sell high, fine. But buying quality, people, product and strategy makes up the quality. But we have a fixation on costs. And okay, when prices come down, we've got to push our costs down. We should have a fixation on margin. And how often do you see a margin curve? You don't see it often. And you know, we've had to push some guys to produce a margin curve. And it's really interesting to look at the different companies across a margin curve rather than just across the cost curve.
That's a very good point. It's in fact, as we went through it with the GFC, that was exactly the point, as I mentioned earlier, about costs. The media only tend to focus on commodity price and don't actually look at the margins, because sometimes, I certainly know that just post GFC, many of the iron ore companies were making a hell of a lot more money than when the commodity price was at its peak. Gary, do you want to add into this?
I don't accept, to just follow up Andrew's point and put a granular number on it. If you peel back the Rio numbers from last week, it's possible to see a production cost of something sub $20 out of their numbers, playing into a current market price, which in Australian dollar terms is in the order of $80. This is a good market. It's a good market and a good place to be in. And for companies like Iron Road, for companies like other Eyre Peninsula-based iron ore and magnetite producers, there is a real opportunity there. And if we can get that CapEx equation right, there is a really solid future for us as a state and as a country.
Okay. We've got some of these questions rolling through now. This is, I don't know, might be a question for Gary, although it is at a federal level. Do you consider the current length of time associated with approvals to be an incentive or disincentive to foreign investors?
Depends what you're dealing with. Let me deal first, Jason, with an approval which I knew a lot about, which was the approval of, say, the Pluto standalone LNG project that Woodside did in my last year of working for Woodside. There were 360 approvals required to drive that project, 360. And my then CEO, Don Volti, complained, as Don does, I don't know how it takes 360 approvals for this. But the government processes approved Pluto before Woodside did. My guess is that in a modern bureaucratic oil company, there are actually more approvals than there are in the public process. Let's not ignore the fact that some of our internal management processes are themselves becoming massively bureaucratic, massively risk averse, and very slow to make decisions. All of us want to see decision making as quick as it can be, and I'm in that camp, but Jason, we also want to see decisions that are sustainable decisions, decisions that can't be challenged increasingly. We're seeing decisions challenged for a range of reasons, and we in government want to minimise the areas of challenge so that when you get an approval, it's sustainable and it's a tradable approval.
Okay. Lachlan, does long approvals times make investors wary?
Yeah, I think it does. It's always, like, there are many factors that you'd value a company on, and some of them you can quantify easily. Others, perhaps like that, it's very difficult to factor in. But I guess for an example, it's if you're trying to do open up a mine in one of the stand countries relative to perhaps Australia, then maybe it's a trade-off. You deal with the bureaucracy, but you can enforce your ownership rights, as opposed to you could just walk in and start shoveling up the dirt and have Big Brother come on, knock on the door and say thanks very much for that. So it's a difficult thing. I actually think at this point in time, with the market where it is, it's a time to try and refine the regulation side of things and fast stream it and iron out all the wrinkles, because at some point things are going to tick up and you don't want to be delayed by regulations when you're ready to strike.
Okay.
So on regulation in general, I've been involved in very small and very big. So BG, the FID decision of the Queensland Curtis LNG project with the EIS and approvals, literally you put them on the floor, they were that high off the ground. You had to put them in the equivalent of a wheelbarrow to get them to where they needed to go to, and costs many, many millions of dollars, to other ones, of course, that are just check the box sort of regulations. The key thing you seek to have as a member of industry is consistency. You need to understand the rules of the road, and the rules of the road hopefully don't change, so that you can plan with confidence, you understand what your budget needs to be, you understand the approval timelines, you understand the rules of the road, and you work hand in hand, hopefully, with government and the departments to make it happen. And it is possible. It's been proven that it's possible. So I don't see that as something that's pie in the sky and can't happen. I think it's something that both industry and government really need to strive towards.
Okay.
So, Jason, if you just unpack that one, we have Queensland, Curtis Island, the British Gas LNG facility from scratch. So from nothing at all in 2008 to first gas in a tanker Christmas of this year. So from a state which had absolutely zero regulatory capacity to deal with that scale of coal seam gas production or any export gas facilities at all in the space of 7 years, I think that's a pretty outstanding approval.
It's a triumph.
You go back to Ian's other comment and unpack it. There's one of those approvals that has 13,000 conditionalities attached to it. 13,000 conditionalities. That sort of thing, we need to be able to, in many ways, Jason, go through the approvals process and then go back and see what we really need in that conditionality as the project unfolds. So you need an iterative, intelligent process that matches good science, good industrial practices, good field practices with lowering costs of production as that business continues to roll through.
Okay. Here's the game show component of today. We've got a question here. Somebody says they've got $10,000. I don't know if they've got their checkbook out and ready to write it out. But they've only got 10,000 apparently. I don't know if we can perhaps add some noughts, that might excite you guys a little bit more. But they want to invest it in Senex or Iron Road. In this
We've
period
got the same major shareholder, so...
they by the way added, in this period of low commodity prices, which company should I invest in? And as an MD, sell me your case. Sorry to do it to you guys.
Let's go 5 each.
There we go.
That's the
And then we can
pragmatic
actually
approach.
see how we go in a period's time.
Jason, can I suggest they put it on Malcolm Turnbull to be Prime Minister before the end of June?
Right, I said we were going to have some fun, but now we're getting political.
Jason, we do have the same largest shareholder on the registry, and that shareholder chases long life, low technical risk projects that can survive cycles. So while we're iron ore and Ian is off doing his thing on something, there are some very similar traits from the investment viewpoint.
Sounds like it's a 5 each way. You can put up your hand if you'd like to see them afterwards. All right, I think we're probably just about coming to the end of it. Have we got time for one more question? I'm looking to my people. Yeah, one more question we've got time for. Okay, what are some of the key risks globally and locally that may impact investment decisions, particularly given the current global instability? Who'd like to tackle that one?
That's a big question.
I probably didn't have time for that one, did we? Does anybody want to try and give us a quick answer?
I'll offer one word: China.
Agree.
Yeah, look, for business investment, the most important thing that business wants and investors want is clarity. And they want politicians to lead, and they want economies generally to be clear in what they expect. So we're just talking about the approvals processes, and you started off by saying, are they too long? I would ask the question, are they efficient, and is there clarity on what's required? Because if there is clarity and there is efficiency, then the time will take care of itself.
Okay. Oh, gee, I've got half a dozen good questions now that have come through. I don't know which one to ask. I might just quickly ask this one, and this is probably for you, Gary. It says, the rise of activism in all its forms is killing our industry. I'm not sure that it's actually killing our industry, but nonetheless, it's certainly making it more difficult. Sometimes there is literally nothing that industry can do against a tirade of lives and half-truths. What can politicians do to help?
We're all subject to that very same environment. Jason, during the very short period that I was the minister, I turned up at a conference in Houston and made this very same point, that we need to address activism head-on and with precision. It's actually why organisations like state-based mining industry organisations like SACOME are critically important. The CME in Western Australia...
We can stop right there, actually, Gary.
They're critically important. Because all of us need to be addressing community concerns directly, frankly and openly, and accepting that sometimes we can learn about what we need to do better. We don't do everything as perfectly as we'd like to believe, and we need to continue the production of wealth in order to look after the needs and the interests of current and future generations. That tension, expressed best as activism, in my view, is best addressed directly. So my Saturday night will be spent with many conservationist friends at a public forum in Perth arguing fracking. I regard getting out there and arguing the case and putting yourself in political harm's way as being a critically important thing. I regard Jay's decision on the Royal Commission in South Australia as being a really important part of that process, of getting out there, getting on the front foot, getting information and dealing with it openly and publicly, but also dealing with it with real purpose.
Agreed. Oh, very good. I should take that opportunity to acknowledge not only Jay and our State Minister, Tom Koutsantonis, but also yourself and
Dan too.
Others
And
who
the
have
State
taken
Liberal
a positive approach, and the Liberal Party, as Stephen Marshall's talked about it also on radio. It's a real good opportunity to have a mature debate, one which we've been calling for a long time. We're really pleased that that's going to happen at such a high level in this state, and that it has that bipartisan support, at least certainly in this state, which is fantastic. All right, look, with that, please join me again in thanking our guest speakers.